The market is currently obsessed by inflation. It's obsessed by the central banks. It's obsessed by interest rates going super high. We saw Bill Ack coming out yesterday saying, interest rates need to go up to the moon. I step back from the narrative and start looking at, okay, what is the reality of that? And I think the reality is, and I'll show it in the presentation, that what we've actually done is utterly destroy demand already. We've had the largest rate of change of interest rates in history, the largest rate of change of commodities in history. We've had the largest rate of change of mortgage rates, all sorts of stuff, a very perky dollar as well, a strong dollar. That makes a big difference to this. Those things tend to be financial conditions tightening. We can see it in the equity market. We can see it in the housing market. You can see it in the crypto market. Conditions have tightened dramatically. The market's still looking at the previous CPI prints, and CPI is a lagging indicator. The forward-looking stuff of the business cycle is collapsing. And that's interesting to me because that fits with my secular framework, which is disinflationary, slower growth over time, with this aging population, demographics, all of this stuff all coming together. So that's why I'm really paying attention right now. I think the market's probably wrong, and I think that it's going to set up for a whole bunch of opportunities as the Fed pivot fast and the economy goes into recession much quicker than anybody expects. So my thesis is demand destruction is what's going on now. Most people have a tendency, economists, people in the commodity markets, most people tend to look at supply. So we know there's a lot of supply restrictions in commodities right now, but people don't realize that the other part of the equation is demand. So most people assume demand is stable and supply is the variable. And I find that demand tends to be the bigger part of the equation. So even if the supply situation is very tight, if demand has been destroyed, then the picture can change super fast. And we've seen it many times in the past, whether it was the 1970s and how people look at money. People look at money supply. We hear that all the time. People don't look at money demand. And money demand is the real thing here. And money demand we can often see through things like velocity of money. That shows the demand for money as opposed to the supply of money. And if there's no demand for money, it tends to be a deflationary or disinflationary environment. If there is demand for money, then it tends to become inflationary. And we haven't seen that. Anyway, so let's look at the big picture. Why everything is happening in my point of view. So the aging population is well understood by many. The baby boom cohort was the largest cohort of people ever at one age in all history. It was particularly prevalent in the United States because Europe after World War II didn't have as many kids and Japan didn't have kids after World War II, so they had more aging populations. But the US has this population baby boom that then started to come through as the baby boomers who are now starting to get to retirement age. So the average baby boomer is now about 70 years old, and they've been coming out of the labor force since about the age of 55 as the earlier retirees came through. So that was about 2000 when they started leaving the labor force. As they left the labor force, what you notice with old people and people's parents, look at them and look at their spending habits versus their spending habits of yourselves or people in their 40s or 50s, those people tend to spend a lot more than retired people. The reason being is they have a finite pool of capital, their retirement savings or their pension, of which they need to live an unspecified amount of time. Nobody knows when they're going to die, and longevity of life keeps rising, so you never really have enough money. So what happens the older you get, the less demand for goods and services you have, and the less you're also actively involved in the economy. So velocity of money falls with the labour force participation rate, which is a reflection of the demographics. Also, because demographics are baked in the cake, we basically know how many kids everybody's had ever since. You can actually forward look the labour force participation rate, and what you get is future velocity of money that keeps falling. So it's telling us that it's very difficult to generate structural inflation in the economy. You'll get periods like we've had now, but structural inflation, you're fighting the headwind of velocity of demographics. also with demographics, if you think of the millennials, who are the next largest population, that millennial population, well, that's a real issue because they're going into the labour force and competing with their parents for jobs. So there's a gigantic amount of people in the labour force at the same time, which has been very rare because the baby boomers have been trying to stay in the labour force to keep their incomes up because the pensions aren't big enough, and the long-term effects of low interest rates and inflation have meant that these people have had to stay somewhat within the labour force. So they're competing with their parents. They've also found that they're competing with the global workforce because of globalization, and that's cheaper workers. So that's been really hard for them. In addition, they're competing with the robots and AI. So technology is relentless in its removal of people from the labour force. And so that's a really difficult situation that we've seen, and that doesn't help velocity of money. You can see going forwards how that works with CPI. We've got this spike in inflation currently that was caused from the back end of the pandemic. I think that gets unwound as CPI follows the births deaths as the percentage of total population, and it leads by 30 years, and it shows us that inflation over time should fall and we head towards some sort of structural deflation, which I think is still on the cards in the years ahead. And if you think about the acceleration of technology, it's telling you that too. And what that's really done is destroyed wages over time. As I said, if you think about these poor people in the workforce competing with each other for jobs in record numbers, competing with the globalized workforce and competing with technology, they've basically not had wage increases since the 70s. So wages have not gone up in real terms. So there's been no productivity gains for the average worker in the entire United States. They've gained 0.2%. It's an astonishing thing, and it shows the dangers of all of these big secular trends and what it means. It basically means you're on a hamster wheel for life for the average person, and that's a terrifying thought. And if you're on a hamster wheel for life and your wages haven't gone up, but asset prices have gone up, and asset prices have gone up from central banks and other issues, which I'll come to, what you've got is an increase in debt. That debt has basically offset the increase in asset prices over the last 40 years. So people have borrowed money to try and make themselves wealthier because their wages didn't go up, but fixed assets did. And we've got the most indebted economy in all history now. Also, the thing about labour force participation rates going forwards is it actually mirrors personal consumption. The pandemic reverting roughly back to trend, and then the reverse of the pandemic after all of the handouts. As that washes out, we should see consumption yet again fall, which lowers the trend rate of GDP in the US economy, which lowers the rate of inflation, etc. Now, the other thing that's happened, the super trend, is the Fed balance sheet is actually an offset to the labour force participation rate fall. So as demographics has driven these people out of the workforce over time, and they've borrowed more money, the Fed have had to offset that. So these things are hugely correlated. So the Fed balance sheet is basically offsetting what would have been the loss of demand in the economy, which is why it's been so prevalent, and it on goes. And I've been following this for the last 5 or 6 years, and it's worked perfectly. And it continues to expect that the balance sheet shall increase. And over the next few years, we'll start hitting $9.5 trillion, $10 trillion, and we probably keep going for a while longer. So that tells you that the economy over time doesn't stand on its own 2 feet, and the Fed need to keep injecting money into the economy, which drives up asset prices, which leads to more people taking on more debt so they can participate in that because house prices and equities and everything have got more expensive, and we continue this ridiculous loop. And the only way out of it is what's happening over time is you get the real rates need to remain negative so you can slowly erode the value of the debt over time as the population works itself out, which we saw in the 1940s and 50s, which is another whole topic for another day. Just to show what I mean again about the fact that the central bank balance sheet drive up asset prices, it's a pretty clear correlation. And I know a lot of people say it's spurious, but my God, it's worked absolutely perfectly. I think of this as actually a decrease in the value of the denominator. If the value of the denominator is, if the denominator is the purchasing power of your dollar, then if you print more dollars, then the purchasing power goes down. That's the supply side of the equation. And the supply side of the equation here, we can see what it does, that the purchasing power of the dollar goes down and assets go up. This is consistent everywhere in the world, everywhere the central bank balance sheet increases, and it works across all asset prices essentially, whether it's gold, whether it's real estate, it affects crypto, it affects stocks. And what's amazing is real estate is so good for this that I've looked at ECB money printing and then looked at German real estate, same chart, Swedish real estate, Swedish money printing, Canadian real estate, Canadian money printing, US real estate, UK real estate, Australian real estate, they're all the same. So what they're saying is every time the Fed print money, the purchasing power of the dollar goes down, which makes it optically look like the value of these assets are rising. Most of them are actually not rising in central bank balance sheet terms. So it makes it harder and harder for those poor people whose wages haven't gone up to stay up. So they keep borrowing money to do it. And it's a mess. And this is what's creating the 1% versus the 99%. Obviously, GDP is the net outcome of all of the things I've talked about. Now we've got this, obviously the weird shenanigans in the price action due to the pandemic, but GDP really mirrors the labour force participation rate. And it tells us that GDP growth over time is going to keep falling and falling and falling. So we're in a slow growth world driven by demographics and debt. The central banks need to keep propping it all up, and that keeps going into the future, and that's baked in the cake. So that's the secular structural view. But now let's talk about demand and where we are in the business cycle. The business cycle is looking like it is about to roll over really hard. And I talked about the massive monetary tightening we've had. This is the biggest monetary tightening in all recorded history in the shortest period of time. We've got rising commodity costs, rising interest rates, and a strong dollar. Those three things together are extraordinary. So here is a combination of those three against the ISM, and it's already pricing in a recession. ISM below 47 is a recession. It's saying the 9-month forward ISM is going to be 37, and it's still going. So it kind of feels that we're going to go into a very sharp, urgent recession, and that's what the markets are picking up. That's what crypto's picking up. That's what equities have been picking up. Equities are currently pricing the ISM on a year-on-year basis at around 49. So they've got further to go to price in some of this, but the comparisons get easier because the market went up a lot this time last year going forwards. So I'm looking closer towards the low, and I'll come into that in a bit. So let's look at the rising commodity costs of the equation and why this is so bad. Food prices, the largest increase in food prices since 1990, and it goes back to the 1970s. So this means if your food bill goes up and your wages haven't been going up, therefore you have, well, if wages have been going up in inflation adjusted terms about 5% and food has gone up at 9%, you can afford less other goods because you keep consuming food. So food is one of these inelastic goods that destroys demand in the economy. And as I said, your wages have gone down in inflation adjusted terms because wages have been rising at about 5.5%, but everything else is rising faster. And that led people to take out more credit again. So credit's been increasing, and credit's been increasing about 6% a year right now, and that's offsetting the difference between commodity prices, cost of living prices, and incomes. The other thing people did was save a load of money over the pandemic because they didn't spend it as much, and they were given direct transfer payments. They've now pretty much eroded it and gone back to trend. Now, you really want to see the personal savings rate increasing, which it's been doing because of the retirees, but we're back to where they were, so all net gains have gone, they've spent all their money, they've started borrowing money. that tells you demand is about to be destroyed, and that any of the retail sales numbers that have been perkier are going to start dying off pretty fast. My view is that for once the US consumer won't be saving the day. And it's kind of something that's believed to be a truism in markets is the consumer always saves everything in America. I think we've probably broken the consumer. So input costs are also rising. So that was the consumer level. But now let's look at all other commodities. Now, we saw the largest rise of commodities again for decades. The rate of change of commodities now is falling sharply, which is why I think inflation falls sharply. The year-on-year rate of change matters the most, not the absolute level of oil, for example. It's the year-on-year rate. That's turned down. We will see CPI turn down with a vengeance soon. But we're still paying for that spike that we had. And that spike was dramatic. That spike translated through to PPI inflation. So producer inflation, input costs, went up dramatically. Now, if you invert those, well, guess what? Higher prices lead to economic slowdowns. So because you've got this indebted old economy, the moment you raise prices, demand gets destroyed. And this is, again, pricing the ISM down at 30, which would be the worst ISM print since 1974, which was an equally short, sharp recession where the ISM fell from 56, roughly where it is today, to 30 in 4 months, which is pretty much what I expect now, something that the markets don't yet understand. But I talked about demand destruction. One of the things that keeps on people's eyes, and as we're speaking today, the oil price is up about 3% at $113. But the business cycle will start to lead year-on-year rate of oil lower. And I fear that oil might be the final shoe to drop, which will wipe out people's fears over inflation. I think oil may well fall. Now, I understand the structural supply issue for oil, but I still think the demand story is the bigger story for now. And we'll look at oil again. We'll think about oil again in 18 months' time once we've cleared through the demand issue. But if the ISM goes down, oil's going down. And the ISM, by the forward-looking indicators, is about to plummet. And oil demand is slowing. You just don't see it yet because it's only in the short-term rate of change you're starting to see it. Now, some of this is the China effect, as China's shut down somewhat. So we need to see where those numbers actually pan out. My guess is we will see somewhat of a slowdown in oil demand, which will help confirm the picture that I'm setting up here.